The US economy is imploding in real time as the leading economic indicators index has just seen its biggest plunge in 17 months. The index dropped by a massive 0.7% month on month, now at the lowest point the index has been at since 2016, and is also now down over 16% from the index peak. A senior manager at the Conference Board said the move pointed to slowing economic activity ahead, citing trade wars as the main reason for this, thanks to the higher inflation, supply chain disruptions, lower investment and spending, and weaker labour market that comes alongside this. The 90-day pause that Trump announced on April the 9th for his widespread reciprocal tariffs is ticking down rapidly, with less than 2 months now left to decide what is going to happen next and which trade deal agreements are going to be made. But investors and financial institutions are getting more and more concerned with the lack of meaningful progress that is being made to get significant trade deals with key trade partners across the line. A few days ago, it was announced that the UK was the first country to agree a trade deal with the Trump administration. However, it was a rather lackluster deal considering the volume of actual trade between the two countries. And the only other meaningful progress that we have seen be made so far and announced by the Trump administration is that the tariffs on China could come down to 80%, which is still far higher than before Trump's tariff announcement, and is also still large enough to pretty much cripple those doing trade with China. The Federal Reserve has noted that there is rising uncertainty and risk of stagflation due to widespread tariffs aggravating inflation as well as slowing economic growth, and recently just decided to halt rates where they are despite Trump's disapproval of this decision. Stagflation fears are certainly beginning to grow rapidly across the economy amongst not just the Federal Reserve, but also from various economists and investors, which is an economic environment which sees a combination of both stagnant economic growth and high inflation at the same time. Periods of stagflation typically lead to higher prices for all consumers and also surging unemployment, which is a terrifying situation to be in. On the stagnant economic growth side of things, we are definitely already beginning to see signs of the economy not only stagnating, but also declining, with GDP growth for the first quarter of 2025 coming in negative at minus 0.3% on an annualized basis. And despite not yet being in the eye of the storm for the trade tariff price surges, we can already see that the cost pressures are spiking for corporations on a similar trajectory to what we saw in late 2021 and 2022, where CPI did reach highs of 9%. Survey data from the Fed and Apollo suggests that the most common action that firms are going to take in response to higher tariffs across both the manufacturing and services industries alike is passing on these cost increases to customers in the form of higher prices. And consumers are seemingly very aware of this and are already beginning to see price hikes as consumer inflation expectations for the next 12 months are also spiking. We are also seeing car prices spike in the most recent data points, which was one of the first goods and broader sectors of the economy that was hit with tariffs even before the 2nd of April announcement. One of the other main consequences and signs of a stagflation economic environment is rising unemployment as companies make layoffs and stop hiring due to feeling the effects of a weaker economy and higher inflation. And once again, the data around this is beginning to look very concerning as well, as the number of job cuts being made by US companies over the last 6 months has surged to 700,000, with April's job cut figure coming in at 105,000. Now, this does mark a continuation of the trend that we have been seeing in recent months of layoffs rising rapidly. And if you exclude the blip that we saw in 2020, this is the highest figure for 6-month rolling job cuts since 2009, which was of course during the global financial crisis. Weakening market conditions across the economy, particularly in the retail and tech sectors, as well as DOGE reducing the government headcount, are all contributing factors towards this layoff surge. Meanwhile, long-term US unemployment, defined here as those who have been unemployed for 27 weeks and over, is also beginning to climb rapidly to now being at 1.67 million, 58% higher than what the figure was in 2023. And as you can see from historical patterns, we typically do see long-term unemployment surge in the run-up as well as during periods of economic recession. And referring back to the Apollo survey data, we can see that unless the situation around global trade tariffs is improved or resolved, another action that companies are planning to take in the future is scaling down operations or closing for business entirely, which will add to the number of layoffs being made. Now, despite the S&P 500 falling close to 20% from the peak to the low seen in the first half of April, the market has since made a strong recovery and is now down just 8% from all-time highs, even though there is no clear resolution to the tariff situation in the longer run. This small correction in the S&P 500 has helped to shift stock valuation metrics, making valuations look slightly more attractive at current prices. However, thanks to this sharp recovery in recent weeks, valuations are still at a very high level relative to historic averages. The S&P 500 forward PE ratio, after briefly plunging to below 18, is now back up to 20.3, which is historically pretty high, with the only time periods having a higher valuation being the dot-com bubble in 1999 and 2000, the peak of the 2020 and 2021 market rally, as well as the recent period of 2024 to early 2025 that we have just seen. Now, this is especially concerning when we consider what we spoke about before, with how many economists and financial institutions are fearing of declining economic growth and inflation, with a heightened chance of a recession, which is of course a scenario which would have longer-term negative impacts on the earnings of many companies. And as we've already seen, the early signs of the economy cracking are there, and we know that many companies have recently given warnings on earnings calls, adjusting future guidance lower to account for worsening market conditions. Now, if we do indeed see the earnings of the S&P 500 companies decline, with guidance getting adjusted downwards too, then this is going to drive these forward PE ratios upwards even higher, unless stock prices decline accordingly. Looking at the Buffett indicator too, which is the total value of publicly traded stocks divided by US GDP, we can still see that we are at a ratio close to 200%. Now, this is a valuation so expensive that it has only ever been higher at the stock market peak earlier this year, and also during 2021 in the stock market peak just before the market saw a major correction take place. Warren Buffett himself, who has said in the past that the indicator is the best single measure of where valuations stand at any given moment, seems to be standing strong on his views that the market is overvalued right now and continues to stockpile cash for Berkshire Hathaway. Now, Berkshire's cash pile just surged to $348 billion, which is a whopping $239 billion higher than just a few years ago in 2022, and also significantly higher than at any other period in history. Berkshire also continues to be selling more stocks than they are buying, and have now been net sellers of stocks for 10 straight quarters. On top of this, market data from Unlimited, who track trading data from 3,000 global hedge funds that manage $5 trillion in assets, shows that hedge funds are becoming more and more bearish on US stocks, increasing their bets on short positions. Hedge funds were notably bullish on US equities in the run-up to the election in 2024, as well as immediately after the results. However, once Trump's policy priorities became clear in February and March, money managers swiftly cut their long positions and flipped short, and by April they had adopted an even more bearish stance. Now, hedge funds became so bearish, in fact, that there are only a few instances since the year 2000 in which underweight positions were stronger, as shown on the chart. Wall Street firms were initially pushed towards a more conservative stance, cutting US equity exposure due to the extremely uncertain policy environment, which was then heightened when Trump rolled out sweeping tariffs and then delayed those tariffs, escalating trade tensions across the world with key trade partners. And Bob Elliott, a former top executive at Bridgewater Associates, said that the current set of policies in place is pretty negative. The likely weakening of the economy is probably a much more important story than whatever Scott Bessent or Trump has to say on a minute-to-minute basis. He also added, weaker growth ahead is not priced in at current equity earnings growth expectations and valuations. The dollar remains very elevated despite its recent declines, and also that US stocks have decades of gains relative to other developed economy stocks that have only modestly reversed. Unless there is a substantial shift in policy by the current administration, these trends are likely to persist. And we could now be a matter of weeks away from widespread shelf shortages across numerous retailers throughout the US, and now major US banks and hedge funds are sounding the alarm on what could soon be complete economic collapse, with something worse than a recession being a possible outcome according to some. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you did enjoy the video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.